Okay, I can see that we have 16 people on the call already. So thank you very much for dialing in a few minutes early. We'll start the call on time at 4 o'clock. So please just bear with us. Thank you to all of you who've already dialed into the call. We're just going to give it a couple of minutes. We're a few minutes early, but we'll try and we will kick off the call on time. So just bear with us for a few minutes. Okay, so just give us one more minute, and then we're going to start the call. Okay, right. So thank you very much. Thank you for all joining the call and everybody sort of dialing in on time. Much appreciated. So I just start to introduce myself. My name is Paul Wilkins. I'm the risk management practice leader for Marsh in Asia, based in Hong Kong. So what that means is I'm responsible for our largest clients and prospects across the Asia region. All the way from India, through to Japan and Taiwan and and so on. So normally this the introductory role would be done by the Marsh India CEO Sanjay Kedia, who I think most of you or most of you know very well. But Sanjay had to apologize at the last moment. He's just been delayed with something, so apologies from Sanjay. But the rest of the team is here today. So so our topic today in the risk management series is alternative risk transfer, and within that in particular, we're going to focus on parametric risk insurance. So this is not really a very new area of insurance, but it's one that's evolving very quickly and generating a lot of interest in the current very difficult, hard insurance market. So my colleague's going to talk about that. So Shruti, if you'd like to just move to the next slide, I'll do a quick introduction, and then we'll get right into the presentation. Okay. So first of all, as we go through, please, just obviously as you're listening, please any questions that come to mind, please just type them in as we go through into the chat, and then we can sort of all engage with each other as we go. Ben may take some of those questions as we go, or he may just wait to the end and we can pick them up. But we'll sort of pick up all the questions. If there's a lot of questions, of course, we'll come back and respond to all of those later after the call. The intention for the call today is the presentation will be around 30 minutes, and then we'll just have some sort of Q&A, and hopefully we can answer all of your questions that you have around that. If you'd actually like to just personally ask a question going through, also please do that. Just raise your hand and we'll open your microphone for you to do that. So obviously with any of these type of Zoom calls, the more engagement and interaction and questions you can all have, I think the more interesting it will be for all of us. We've just got one quick poll question, like halfway through the deck, so you could participate in that. Again, that's good sharing, helps us all to understand what we're all thinking around this topic. So this is part of a series of 8 calls around risk and the new landscape of risk following everything we've learned in this pandemic environment and working from home and so on. So this one I think is number 7. We have one more to go, number 8 in the series. So number 8 next week, again, a very interesting topic. It's called, around risk finance optimization. So this relates to the topic of how much risk should I retain? What is it worth paying for my insurance? Should I be thinking about alternative forms of risk transfer that we're going to talk about today? And then maybe, should I be thinking about a captive insurance company? And we've got our colleague from the UK, who is our global head of analytics, and basically does this, all day, every day for global companies. So I think that will be a very interesting session as well. So if you have the time, please do join that one as well. Okay, so finally, I've done a quick introduction myself, but now our speaker today is Ben Qin. Ben has been in the insurance industry for a number of years. He's worked for Marsh for almost 10 years now. But Ben leads alternative risk transfer. So basically all things that are not traditional insurance for the Asia Pacific region. He's based in Sydney, but he's responsible for the Asia Pacific region, and he works with the team in India. And increasingly we have colleagues in each country in Asia, including in India, who focus on alternative risk transfer and work with Ben to develop solutions for different clients in different industries. So Ben's going to talk about a little bit about what is this, and also to give us some examples. But again, once again, please encourage you to chat as we go through and raise any questions that you might have. So Ben, over to you.
Oh, thank you very much, Paul. Can everyone hear me? Okay.
We can, Ben.
Good. All right. So I'd like to just start off the presentation by looking at this very quick and high level statistic about the history of insured versus economic losses in the world, right? So I pulled this statistic straight out of the Swiss Re Sigma report. They publish this every year. I didn't manage to get it up updated for 2 years, but this one is as of 2018, but it shows a very neat trend that we're trying to prove anyway, right? So there's two essentially time series in the data, if you like, right? The first one is the blue bars, which shows your historical insured losses, and you can see that across the last I don't know, 3 or 4 decades, and then in the more recent 2 or 3 decades, the losses in terms of insured losses, they've more or less gone to a different level compared to the previous years, right? That's not unexpected. You got global warming, you've got all sorts of weather, increased climate change losses or weather losses out there. So truth be told, the increasing exposures and the increasing sort of these losses, you're gonna almost expect that, right? The first time when I looked at this graphic, what was surprising is actually the rising trend of uninsured losses, right? And you can see it's a clearly trend of being much higher than your insured losses there, right? So it kind of shows a couple of points, but one of the points, the key points that we want to address today is, how have traditional insurance evolved, right? Or how have it not evolved, right? You can clearly see here, it hasn't really kept up with the trend of the economic losses and the risk exposures that our clients and corporates and public sectors are really facing out there, right? You can see that trend is clearly outpacing what traditional insurers can do in terms of insured losses, really. Next slide. So this is where we get to this invention of this whole umbrella of products, which we term under alternative risk transfer. We cover all sorts of things in there, and some of these products have been around for years, right? But it's all been very esoteric for very niche sort of exposures, but now have become a lot more mainstream, right? So they're not new products at all. They're just variations of things that have been invented by other people over the last 2-3 decades, and they've been popping up more and more these days. And we term it under alternative risk transfer, ARTs. And roughly, I'll put them into 3 categories, right? You can see the 3 pillars that I've got on the screen there. The leftmost pillar, the first pillar, we're talking about the underlying risk. It's still a traditional insurable risk, but it's being packaged or structured in a different way, right? So the classic example of that is, the first one is the integrated risk package, which could be in the form of a multi-year or a multi-line, right? So it becomes more of a capital transfer of a particular risk over a number of years, and we do away with the whole concept of standalone annual insurance policies and annualized wording and standalone sort of risks out there. And you can see on the remaining part of that category, there's a whole bunch of jargons and technical terms, which I won't go into, but just keep in mind they're all traditional risks, traditional insurable risks covered by insurers, but just packaged in sort of different ways. What I wanted to focus on is actually the second and the third pillar around this whole concept of parametric solutions, which revolve around weather and commodity typically over the years, but we've also seen solutions pop up in that non-physical damage business interruption, short for NDBI solutions, right? And that's where the whole concept of non-indemnity solutions pop up, right? So if you think about traditional insurance, what is the difference between your typical indemnity solution, which indemnifies the insured back to restores you back to the position before the loss, compared to a non-indemnity solution, which is typically a pre-agreed solution claim, right, or pre-agreed financial reimbursement, right? And why do we need that? I'll go to that in a second. It's all about solutions that are here to address particular gaps, specific gaps where traditional insurance leaves off, but also it's there to address specific risk issues that corporations face today. Next slide, please. So before I do go into the specific examples, I like to just show a quick comparison of traditional versus your non-indemnity, right? This whole concept of non-indemnity. So if we think about traditional insurance, the first line, right, and that's the crux of how insurance can actually stand on its 2 feet, across all these years in the traditional manner, right? It's all about what's insurable is linked to the fundamentally, some kind of a damaged event, right? The condition of this property damage event is imminent across most of the PDBI policies that we see, and the subsequent lines around a loss adjustment process and indemnity process, they're all around the fundamental condition that it needs to satisfy this proof of damage concept, right? So on the other side, where you have a non-indemnity product or a solution, you actually do away with that original requirement for having physical damage to the site, right? And with that, it actually opens up a whole realm of still within the realm of insurance, right? We're still talking about protection against an underlying risk, but the process and the procedures that's associated with property damage and traditional insurance, it goes away, right? So we're talking about this whole concept of a pre-agreed settlement, right? And the promptness of that settlement, because it's based on an external data set, and it's settled typically via online or a digital mean, that the need for a physical loss adjustment process and the time it takes, it just goes away, right? And the time it takes to a claim for a parametric insurance is typically within 30 days to confirm. Within 60 days, you get a check in the account for the claim. Next slide there. So just a few examples of how we see gaps are left by traditional insurance and picked up by parametric covers, right? So in the whole world of natural catastrophe events, right? So if you think about it, the actual underlying event, right, it's still the same, right? We're still talking about typhoons, we're still talking about floods, we're still talking about earthquakes, right? But the actual indemnity process, right, of that, for whatever reason, traditional insurance wouldn't necessarily work. Like to give an example, the first one we're talking about when you don't own an asset, right? When you're not insured interest to a particular asset, you don't really have the indemnity of whether that asset gets damaged, and that's linked back to your economic loss, right? There is no correlation of that. I think supply chains, right? I think contingent business interruption, and that's where parametric cover or event cover comes in quite handy, because it's all about pre-agreed based on the event, right? So you don't need to own the asset. You don't need. I mean, all you need to prove is some event in some form or shape pre-agreed has happened, and you get a pre-agreed payout as a result of that. So all the other examples along the line are all along similar concept, right? So if you don't need to prove that you've incurred costs, and you've suffered indeed, a loss of revenue or an increased cost, then you're pretty much relying on on your pre-definition of that non-indemnity, right? So all the remaining parts about drop in sales, it's all about what you pre-define first. If you think this event's going to cause this much drop in sales, you simply predefine it, right? And that becomes part of a viable solution to provide you protection against that particular risk. And keep in mind, all these are for cat risks, right? For your natural catastrophe events, where it's a subsequent indemnity process, and that's where you don't really have that traditional insurance cover. There are other types of events out there. Your financial losses, typically what we term as non-physical damage. Your NDBI cover is where you've got a range of other triggers and other events that can be defined in a parametric sense, right? So if you think about in pharmaceutical industry, where there is a regulatory trigger in food and beverage, when you've got FDA recalls, right? You can actually use that data, and you can set up a settlement mechanism that relies on that particular trigger, which still incurs an economic loss to the organization, but not necessarily covered by a traditional insurance means. Pandemic is a great example. We're in the obviously living in the middle of one now, where it's quite sort of proof in the pudding that you don't need a physical damage to really see a loss of that value and economic value to the organization, right? Pandemic is a great example of that, and there's other weather related losses out there that are non-catastrophe that are also subjecting to different sectors and different organizations to economic losses. Think agriculture, think retail, right? They're all subject to temperature fluctuations, lack of rain, too much rain, all that kind of stuff. It's all in the realm of possibility with the parametric solutions. So I've got a few sort of these sold examples that I wanted to share, just to have some ideas and have some discussion around some of these concepts that may or may not work for India, but that's what we've seen. It all starts off with a concept. The first one is not a parametric cover. The first one is just what I wanted to show as an integrated cover, where we help. This is the food and beverage client actually, but they've got your typical standalone silo insurance cover. You've got your general liability, your motor, your crime, your marine transit, and your property, and they simply saw insurance as a way of a capital transfer, especially at the higher end, where you don't see any losses, and all you're doing is just you're trying to secure capacity, right? So we saw an opportunity in there to organize a multi-year cover where you don't necessarily need to go in each year and look at your annual programs and your wordings and your secure capacity, and you find insurers out there. We did a 3-year program with this particular client across these underlying layers, right? So the key there is that there may be cost savings, but the full cost of accounting, it's not the 1 year, right? It's across your 3 years or your 5 years, right? And that could be especially important in this day and age, especially in the insurance world, when we're facing potentially increasing insurance costs, right? So maybe you want to lock in rates for the 3 years across the bulk of your insurance spend, and that's and that's definitely one way of doing it through an integrated program. Next slide, please. So this other example is around specifically Nat Cat, around earthquakes to be specific, and that's where we saw a need to plug in a gap where traditional insurance down the bottom in what we call a primary layer is either cost restrictive or it's capacity restraint. Right. So in this case, we've actually set up the parametric as an underlying layer reacting first to a 300 million of a loss, and after exceeding 300 million, after exhaustion of the parametric layer, there is traditional cover sitting on top, right? And that's and the traditional cover sitting on top is purely a function of its lower cost sitting on top because of a lower probability event, and also locking in a much bigger capacity behind it, right? And what's sort of unique about this solution, right, is because if you think about how traditional cover reacts versus your parametric cover, right, it's actually reacting on two very different types of triggers, right? So the underlying event is going to be earthquake. In this case, we were able to organize earthquake triggers as a function of weather and geological agency, and the payout on a parametric basis reacts directly on that data set, whereas the traditional indemnity policy works on the impact of damage, right? So after loss adjustment and all those things, you work out your deductibles and you work out what your various layers are. So there's potentially a gap in between where traditional and your parametric, it doesn't sew up as well, right? And that's where we've looked at this innovatively and say, hey, actually, let's try to close up that gap with sort of a buffer, right? And we call this a drop-down provision where there's certain conditions. If certain conditions are met, the traditional cover will actually drop down to provide a buffer where there could be room left before the parametric policy gets exhausted and before the traditional cover would actually drop down otherwise. So there's a drop down provision as a result of sewing up the two cover, and the result of that is overall total cost savings as well as increased capacity because we're able to add in the underlying capacity there on a parametric basis. Next example. So this is where we looked at something where the client owns network assets, typically what poles and wires and cell towers and all those things around in Hong Kong, or centered in Hong Kong, and we were able to look at a data set specific to typhoons tracking in Hong Kong. But if you think about your means of traditional cover, there really isn't much out there in terms of network assets, right? So, before we looked at this parametric policy, the client was pretty much uninsured and subject to the volatilities of windstorms and typhoons, whatever, in the region. The orange line happens to be Typhoon Mangkhut, the recent one in 2018 that hit close to Macau and Hong Kong, and we were able to organize the solution so it paid out had Mangkhut were to cross Hong Kong again, and that was to use this whole concept of a cat in the box solution, where we looked at where the typhoon would cross a circle on a map, hence why it's cat in the circle, and we looked at 110 kilometer radius around the Hong Kong observatory in that example, and that was a 25 mil capacity that was secured for that client as a result of that. Next slide, please. This other example is around an earthquake and around a magnitude scale, and this is a contingent business interruption issue for the for the client, because they actually don't have any physical assets in Manila, right? But they're subject to a call center risk, where majority of their call center and the service are centered around the Manila region. So the idea there is that if an earthquake happens in Manila, it becomes a key supply chain issue for this company without actually subjecting them to physical damage, right? So again, it's organized as a digital policy, and it pays out according to what USGS would record as earthquake data. And it's instant payout as soon as USGS data is able to confirm that. And that was done as a 3-year deal for 25 mil US. Next one. Good. Okay, so another earthquake example, but I wanted to show the distinction between, so previously it was done on a magnitude scale, whereas this one is done on a intensity scale on a one single location. And the difference being that, this is a construction risk, but actually it's regardless what kind of risk it is. You just need to prove that you have economic loss as a result of the earthquake event, right? You don't need to necessarily have damage. But the difference here with the intensity scale is that no matter where the earthquake happens, as long as you define your own location, in this case, it's marked by a star on the map, it becomes the measurement of intensity of an earthquake can be measured at any point on this earth, right? So that's where it becomes a bespoke scale just for your predefined location, and that's usually a much better way of looking at earthquake cover instead of your magnitude, because your magnitude is it's only measured at the point where the earth is shaking, right? Yeah, which is the epicenter. So it's a very different concept to move into an intensity scale, and we think it's much better for some clients that have this sort of single location or a fixed location exposure, as opposed to a sort of area wide cover. And that was done as a 10 million annual deal. Next one. I've got this example in Australia, but actually it should work in theory once you have a clear enough and a reliable enough data set, right? So this is for a construction project, but again, you can do it for any other sort of risk or a project. The client's building a weir downstream. They've got a measuring gauge upstream, which they use to measure the height of the river as well as the velocity of the river flow, right? So we simply look at this as a non-damage function, simply because the client's already building a weir on site, right? And they're expecting the floodplain and the weir to get flooded. It's the function of where increased costs come in. It's only when it gets flooded above a certain level. So in this case, they're building a cofferdam that's exceeding 5 meters. And it's only when the 5 meters, the river height is exceeded, they cannot work, right? It's tools down, and it leads to a delay in that project. And the longer the river gets inundated, and again, we're not talking about any damage, because inundation means it doesn't necessarily lead to damage. It just means that you simply cannot work. And history have proven that this river can be inundated for as long as 3 months or longer, right? So depending on whether it's a wet season or not. So we've been able to structure this cover in a parametric sense. So it attaches straight away to to the measuring station upstream, as indicated by that lower red arrow there, and it looks at simply how many days have been inundated, right? How many days have this river been inundated or flooded, right? And if it exceeds a certain threshold, it just means that it's going to blow out the project costs. And again, no property damage, so your contract works and your delay in startup cover, it's not going to react at all. But in this case, because we've defined it in terms of the number of days, and there's $100,000 payout per day, there is $15 million cover as a result of inundation and the delay costs as a result of inundation and flooding. All right, so again, I mean, we need to find relevant data source in parts of India for this to work, but this works in theory in any part of the world where there is a good, reliable data set we can use for measurement. A timed, like a historical time series, as well as some kind of a future settlement in the case that you do suffer a loss or a delay or a cost or a loss of revenue. Next slide. Okay, so we've got this poll question here, where we're going to ask you, in what sense have you encountered alternative risk transfer solutions before, and what are the main deterrents for you and the organization to not really pursue it, or do you see any barriers in the future for not pursuing this cover, right, or this type of product? So we got sort of this multiple choice thing. We got A, B, C, D there. If you could just make a selection on the screen, we can sort of assess the outcome of the panel there. Oh wow, okay, that's a bit unexpected, but okay, good. Okay, good. I mean, it's reassuring. No one went for choice D, but yeah, I mean, we do have a sort of a Q&A for each of those choices, right? It's sort of like a cooking show. Here's what we prepared earlier. Are the results going to flash up again, or just waiting for a couple? Okay. No, okay, they haven't changed. Okay, good. Yeah, so the Q&A of this, right? So, I mean, we've got a global hub of these, ART experts in different strategic hubs around the Marsh world, and we've encountered all these questions before. So we are simply collating experience and expertise from everyone to come up with these, and some of these, like, I simply just call them myths, right? So the first one is around, oh, it's too expensive, right? So what are we actually comparing it to? So this is where you actually say, well, if we are using ARTs or parametrics to plug in a gap where traditional insurance can't address, right? And we're not comparing apples for apples. If we're not, all you're doing is simply comparing a cost of an apple versus a cost of an orange, right? It's a very different thing. So people say, well, oh, it's too complicated, it's got too many jargons and all this sort of thing. But actually, once you actually get around it, it becomes a financial contract that organizations often deal with much more complex things. Your foreign exchange swaps and your interest rate derivatives, all these kind of things are way too complicated for us. But typically a typical parametric insurance product, policy and wording. So get this, right? It's about 10 pages of a wording, right? So if if you're used to looking at your ISI or your PDBI cover, it could go on for tens of pages and 50 pages, all together with 20 pages alone in exclusions. By the end of the pandemic, I'm sure should be a lot more exclusions out there. So the third one is the most popular choice everyone went for. It's only available from very specialty and niche insurers. It's true that there may not be any local insurers in India market offering this cover, but most international insurers and reinsurers do offer some form of ART or a parametric cover. All right, so we've been able to secure capacity, and a lot of a lot of international insurance and reinsurance flaunt their capabilities in the parametric world, simply because it's the thing to do today, and it's the thing to address client needs, right? In an evolving world, right? This whole thing around covering for uninsured risks, right? So I think every day we keep seeing news about new products coming on the shelf, coming out by an international reinsurer or an insurer, right? So I'm sure if you do a simple Google search, you'll find a few of them in the market, and there's a lot of mainstream players that are out there that are offering the bulk of solutions, right? So that's typically our go-to markets, but we do have other niche products out there for the niche solutions. But the mainstream, the bulk of the product is always there to cover it. And the last one, I'm glad no one went for that choice, because insurance, in a way, it's about gambling anyway. Whether you gamble more or less, and depends on how much you pay. How much you want to pay up front, right? So that risk and reward equation is what we as risk professionals and insurance professionals have to juggle with every day. So much like how much you want to put down on the roulette wheel anyway, right? So it's just the fact that you're in the insurance world just means that you're actually accustomed to the whole concept of gambling and risk and reward, in striking a balance between the two, anyhow. So it shouldn't be any different. I think that's it. Yeah, so I throw it over to Paul.
Great. Okay. Thank you, Ben, for the presentation. So you've covered a lot there. So I just talk just a little bit for a few minutes about what we see happening around Asia, in other countries, and how this is evolving. And then together with myself and Amir, we'll sort of host the Q&A session. So again, I can see there's like one question in the Q&A tab, but it's an interesting topic. But please, send through any questions that you have. So in Asia, I mean, I've worked in Asia for 20 years. The first time I really saw an ART deal get done was probably about 15 years ago in Taiwan. Taiwan, of course, has an earthquake exposure, and then there's a government scheme to provide insurance for residential properties in the event of an earthquake. There's various different layers, and there was a catastrophe bond that was triggered by a parametric trigger put in place about 15 years ago. So that was sort of quite early on, sort of quite innovative. And then around the region in Japan, we see different companies buying cover, again, for earthquake, because earthquake is the big exposure in Japan, probably to supplement in some way the existing coverage that they have. In more recent times, if we look towards, say, Hong Kong region, where I am, in Macau, as we know, is like probably the world's largest sort of gambling area at the moment. There's a lot of very high value assets in a very small area that is subject to windstorm. And they've had windstorm losses in recent years, made windstorm very expensive. So we have some of these casinos now that are looking to buy parametric type coverage around windstorm. Again, not instead of, but to supplement their windstorm coverage that they buy from the traditional market. And then, so generally around Asia, we have sort of, it's an evolving area. So as both Ben and myself said at the start, a lot of these concepts are not new. So you say, well, what has changed now that's made it a more interesting topic for everybody? And there's a number of things changed. Not the least is insurance, after sort of 20 years probably of being in a soft market, has suddenly become a lot more expensive. I know you've all experienced this in a very significant way in India with the moves that GIC have imposed on you. But in a different way, the cost of insurance has been increasing globally. It's been increasing, all around Asia Pacific region. So it's gone up, and the current sort of view is that in this environment, when insurance companies cannot make any money from investments, have made losses in recent years, that the trend will probably continue. So we've moved from really 20 years of insurance just being so cheap that you don't really need an alternative, to insurance progressively becoming quite expensive to where you do need an alternative. And we hear from many of our clients is that when we need to tell them that insurance costs have increased, increasingly they say, you need to bring us some alternative. You need something different. So increasingly we see that those alternatives are coming from the non-traditional market. So it's that the whole market environment is one thing that's changed. COVID is something that's changed. COVID has probably been the largest economic loss that we've kind of seen globally sort of in our lifetimes, but only a very tiny percentage of that is actually insured, because it's not a physical damage type event. So companies have realized that a large chunk of their values and a large chunk of their exposures are tied up in their non-tangible assets. But those non-tangible assets are not so well covered by traditional insurance. Traditional insurance is great for property damage, tangible asset losses, well established. But when you start moving into the non-tangible areas, like cyber and intellectual capital and things like this, the market is a little bit sort of lagging behind to catch up with this. But there are sort of solutions for those things in the non-traditional market. So we're seeing this kind of the perception changing. The other thing that's changing is the modeling as well, because like with everything, we all have more data, and we all have more measuring points. And with more data and more measuring points, and the use of AI to crunch vast amounts of data, the modeling is becoming more and more sophisticated. So really, in the past, 15 years ago, when we talked to clients about ART, they said, well, the modeling is very crude, so this seems like gambling. The trigger may be hit, the trigger may not be hit, and the result is completely different. This feels like gambling, but very interesting, your response to the poll question is that it doesn't feel so much gambling now, because the modeling has become so sophisticated.
So, Paul, we lost you. Sorry. Seems like a poor connection. Just a second.
Welcome back, Paul. We had just you're on mute.
Yeah, apologies for that. My line dropped out. So one by one, we've seen all of the large insurance companies and some new players increasingly coming to the market to offer cover. So kind of almost every week, Ben is sending to me examples of new transactions that have been done in new areas, in new countries. So it really is a very much an evolving area, and it really is very much about now. So I think in our risk series, the risk finance optimization of kind of, how much should I pay for my insurance, and what sort of deductibles should I carry? Should I consider non-conventional solutions? And should I maybe even consider having a captive insurance company, are really on the agenda now of all very large companies. So these are, bespoke deals. They are deals that are done for specific coverage or specific companies. They're not off-the-shelf type products. So the volume is not great, but the premium that is going towards them is increasing, and we expect to see that to continue to increase. So that's just like an overview of the Asia environment. So Amir, I'll just sort of pass it over to you, and maybe we throw it open for some questions.
Thanks a lot, Paul. And we request everyone to maybe type in their questions, or if you could just raise your hand, we could get you onto the call. We have Mr. Yogesh from Thermax joining us today. So Yogesh, your question, please. Maybe.
Yeah. Can you hear me?
Yes, very much. Please go ahead.
Yeah. Good evening, everyone. Thanks for the nice presentation. I was wondering, considering the regulatory framework that we are in India, so how this solution can be made more workable and practical. So if you can just let me know on that, it will be helpful.
Ben, I think it's for you.
So regulatory as in insurance regulations, or are we talking about for particular industries and the impact of regulators?
No, my question was more from the insurance regulator perspective.
Oh, got it.
Yeah.
Got it. Yeah, so most of these parametric products have now been made mainstream simply because they've been either transformed or in its original form in the insurance space, right? So most of these products are made for everyday mom and dad retail insurance buyers. They've either been manually transformed within the insurance company itself, or they've just been dealt with at an insurance wording, so it looks and smells and same, like exactly the same as how any other insurance policy is structured and issued. So most of the cover in, for example, for Nat Cat cover has all been done in the parametric space, have all been in that insurance wording. I'm guessing you're alluding to the fact that there may be these in the past they may have been done under financial derivatives or ISDA formats. That's all been changed. I mean, there's plenty of these transformer vehicles out there. If the underlying issuer cannot issue in insurance, we can find a transformer vehicle to transform it into a regulated insurance policy, right?
Okay.
So it
Understood.
just becomes
Thank you.
Yeah, if I could add, so Allianz, for example, who obviously operates significantly in India, are writing quite a large volume of this type of transactions now.
Okay, understood. I would be happy to connect with your India team to discuss further on this proposal. Okay.
Thank you, Yogesh.
Thank you, Yogesh.
Yeah. Thank you.
So Ben, we have a couple of questions on the Q&A. One is on the structure, which requests to explain the drop-down provision by way of an example.
Sorry, the first one, right? The drop-down provision.
Right.
Yeah. So that's quite a proprietary example. We'd like to we like to keep everyone in the dark for now. But the whole concept is around, if you wanted to use parametric insurance as a way to replace property damage cover, there is a way, and we've done it. and it's through this effect of a drop down provision, or you can use like a buffering zone in between, and that's where you can help to save the premium cost of the entire tower, simply because you're using a mixture of parametric capacity versus your indemnity capacity, as well as just open up more capacity if you're not concerned about cost, really.
The next question is from Jigar, which Paul seems to have partially answered earlier. Which are the main capacity providers for parametric cover?
Yeah, most of your everyday sort of reinsurers would offer some form of cover in the parametric sense, simply because they also issue catastrophe bonds and whatnot at the back, also using parametric capacity. But more and more retail insurance companies are coming on board to this whole concept and becoming mainstream. I mean, Allianz is a great example of that. AXA XL is another great example of that, where it's their mission to make parametric insurance accessible to everyone, really, to retail clients as well as large companies and corporate institutional buyers out there. Typical capacity could vary anywhere from USD 20 million to 200 million. And it really depends on the underlying trigger, the underlying event, and the underlying data set which you're insuring to. Obviously, the more commoditized and the more accessible the underlying data set is, the more capacity someone can put down. But the more niche something is, obviously everyone has to go through a due diligence process, and it may not go through for everyone. So that's where capacity may not be so abundant there.
The next question is from Darshika Verma. This is on the claim settlement aspect. How will it work in the event of a non-damage BI? And what are the possible parameters that can be set for this?
Yeah, so NDBI is a very vast term, right? It's a very big umbrella term. So there's so many sectors, so many data sets and triggers that can be had. I mean, if you think about in the pharmaceutical space, there's NDBI solutions around, for example, regulatory action. So, some kind of a external, like a regulatory action that someone's imposed on you typically from like a government authority. So that could be used as a typical trigger. If you think about in real estate, investment trusts, you can use something like a foot traffic as a way of measuring economic loss, or a form of an economic loss, and that could be a form of your NDBI. In the space of foot traffic and all that sort of stuff, you can use in retail as well, right? So there's typically the criteria for setting up a NDBI data set and the basis for settlement is really about, if you've got a historical data set, a time series that is predictable, that can be modeled upon, it's external and it's verifiable, and it's independent typically by a third party. And that's where you tick all three boxes, and someone will take a look at that. Right, and that's I guess the crux of the NDBI covers that are out there today.
Great. So the next question is on the banking lending space. So this is how can I ensure my credit portfolio against any default or decrease in portfolio quality, and what are the triggers that can be thought of?
Yeah, absolutely. I mean, we came across similar examples where investment banks or mortgage-backed portfolios, right, look at it from I guess a contingent credit risk, right, turned from an operational risk, right? When you're operating in a particularly cat exposed region, and you see people go into a higher arrears rates or higher default rates after an event, right? You know, you give, it happens when you're exposed to a region of you know, mortgage financing or loan financing in a particular cat exposed region. The cat event sweeps by, so a windstorm, flood, whatever you want it sweeps by. People are left homeless, and they typically default on their homes and they walk away, right, from that financing, right? Whoever's financing it is left with a massive hole, because it becomes a systemic accumulation issue, because everyone's going to default after an event, and that as long as that event can be again measurable, externally verified through a data source, all you need to do is measure, well, predefine a correlation between what you think is going to be the default impact versus the catastrophe impact, right? So once you marry the two and you say, well, we think, you know, like a windstorm of this size is going to cause a 10% default rate, whereas a much severe windstorm event is going to cause a 20% default event, right? Once you agree on that scale, right, which is the correlation between default arrears versus the severity of the cat event, that will be in effect the structure or the term sheet of that parametric policy, right? And then we can go to the market with that type of you know, concept and a term sheet, and find the relevant data source that we can use to measure both the catastrophe and also the credit default.
Thanks, Ben. I think that structure kind of demonstrates to the extent that you can structure such solutions, and I mean, it's quite great. Okay, we have Mr. S.K. Goel. He wants to ask a question. Over to you, Mr. Goel.
No,
Sorry.
you might be on mute.
Sorry.
Yeah, Mr. Goel, you have to unmute yourself. Yeah, we can hear you.
Yeah, good evening, everybody. Ben and Mr. Paul. No, I was just thinking in terms of the parametrical or this untraditional, how far GIC has been able to conclude deals with you somewhere in the Asian part. Mr. Paul, is GIC been able to put some proposals forth, and which are in your knowledge from India?
Mr. Goel, actually, very, very good question. To my knowledge, no. But I'm not, yeah. So the short answer is no, I'm not aware of GIC participating on any of those deals. But as I said, the situation is moving very quickly, and all of the big name insurers, one by one, are coming and offering capacity. So I feel that GIC will get there, even if they're not there at the moment. But it's a very good question, and it's something we will probe a little bit to find out what is their appetite around parametric covers. But good question, thank you.
Yeah, because we would like to encourage in India, like some of the clients, like Thermex, they are coming forward. It seems there is a good future. There is hope that this market can evolve in terms of non-traditional covers, and India being an expanding economy, this could work out very well. But we need some more sort of information, informal and formal way of communications to the general public to make their interest alive, with some examples, with some sort of ease of.
Yeah, probably the most high.
Okay, thank you. You raised a very good question.
Yeah, thank you.
I was just going to say the most high-profile case in India so far for parametric cover is the state of Nagaland actually organized a facility for parametric cover based on excess precipitation. So I understand the province of Nagaland probably gets a lot of rain or excessive rain, even outside of expectations during the monsoon, and that's where they were able to get cover, and that's all in the public domain, right? And it's for their citizens really at the provincial level, and that's probably the most high profile case, only done this year.
Yeah.
Ben, could you just, I know we're sort of running out of time, but could you just talk just for a couple of minutes about renewable energy? Because obviously renewable energy is huge in India. So maybe just some of the types of covers that the renewable energy industry.
Yeah. So energy like if we're talking about underwriting energy fluctuations, especially renewable energy, right? It's all very dependent on the underlying weather source. So if it's solar farms, it relies on irradiation being the source of energy feed. If you're talking about wind farms, then of course it's your wind, right? It's how much wind do you get across the year, and your daily patterns, is it going to be expected or is it going to be very volatile and unexpected? So we see a lot of sold examples and cases in the renewable energy space in Southeast Asia that has popped up recently. Again, it's nothing new for the rest of the world, but only because I think when the state of the insurance market is maturing in Asia, and the understanding of risk is also maturing. This is where there's more and more just examples of these smarter financing things that are coming up. And again, it's just about a different way of transferring capital, right? So it becomes a cost-effective capital transfer for these lender-backed renewable energy projects that are coming up, and that's where we see a lot of traction in that space as well.
Okay, so Ben, thank you very much. So we've run a few minutes over time, but I see that 90% of the participants are still on the call. So hopefully that's a sign that it was an interesting presentation. But as always, if you have any questions or any thoughts about the presentation afterwards, please follow up with the India team. The India team have full access to Ben and all of our global resources around Parametric. As we said, it is very much an evolving area, but I think it's one that we're all going to hear a lot more about over the coming years as the traditional market becomes more difficult for all of us. So, thank you very much, everybody, for your participation. Much appreciated. And
Paul.
that's the call.
Paul, just time for one last question, and from one of our clients.
Oh, okay.
I'd just like to welcome Shraddha from Tata Technologies. So, Shraddha, please go ahead with your question. Yes.
Yeah, maybe it's
Hello?
on mute.
Yes, Shraddha, now we can hear you. Please go ahead, Shraddha. Okay, there seems to be some issue. She's just mentioned unable to talk. Can you hear us? Or you can just type your question on the Q&A.
Yeah, so in the meantime, whilst we wait, there's another question I'd like to address there around other than Nat Cat events, what other parametric covers? Yeah, I mean, we see reputational damage where it's around the stock price and the volatility of stock price. we see, in the real estate, I mentioned about foot traffic information. There's, weather data from satellite imagery. We look at some of these regulatory actions or inactions, non-damage cover from, active shooter scenarios, protests and that kind of scenarios too. We look at pandemic, or for the next pandemic, there's going to be a few insurers with capacity lying around for non-damage business interruption pandemic cover. So yeah, there's quite a lot to look at there.
So I must say thanks, Ben. Thanks, Paul. It seems that Shraddha is facing some issues, so we can close with any remarks from your end.
Yeah, great. Okay, so again, so please, any questions you have, follow up with the India team. India team has full access to Ben and the Marsh Global team, increasingly big Marsh Global team that's kind of working on alternative risk solutions. Thank you very much for your time.
Thank you everyone for joining.
Have a good evening, afternoon.
Thank you, everyone. Thank you.
Thank you.